Hi everyone, welcome back to my channel. Today, we'll switch things a little bit up. First, we'll discuss about an investing framework which has worked really well for me in the past. And post that, we'll discuss about a company which fits right into it and why I believe the company is set to create long-term alpha for its investors. So over the last 8 years, when I first started investing, I've worked with some of the most influential people in the industry and I've tried and tested multiple investing strategies, something like a deep value investing or identifying turnaround stories. But lately, what I've discovered is most of these don't work. Something which is trading at a 50 to 60% discount to its peers is trading there for a reason. And there's no reason why it can't trade at a 60 to 80% discount. Most of these companies don't have a margin of safety in bear markets. Something which has worked really well for me in the past is a company with the following characteristics. First, the industry. The industry which the company is operating in should be a long-term structural story in India. It should have a long runway for growth ahead of it. Some industries in this context can be banking, consumers, manufacturing, and many more. The second cut to it is that the industry should be going through some turbulent times. For example, the consumer sector in India was going through some turbulent times over the last 7 to 8 quarters, majorly because of the slowdown in the rural and middle income expenditure. The second is the company itself. The company should have rock solid fundamentals. It should be one of the strongest in the industries. It should bounce back the fastest when the industry comes back. Such companies usually end up getting a lot of market share in such times. Lastly, the valuations. Nowadays, the market changes the themes and trends so fast that the moves are often swift. So identifying a company which is currently being ignored by the market and trades at reasonable valuations become the key. Now, we have spent enough time on the investing framework. Let's get into what we have for today. So today, we are going to talk about Sapphire Foods, which is one of the largest QSR chains in India. They're one of the two operators for Yum brands in India, through which they operate KFC and Pizza Hut. They also run the largest QSR chain in Sri Lanka through their brand Pizza Hut. India food services industry is massive, serving almost 1.4 billion people. And within this $50 billion market, there's a massive shift happening from unorganized to organized. This is on the back of three key reasons. First, increased income levels of the consumer. Second, increased number of options available to the consumer. And lastly, more number of people joining the workforce, because of which out-of-home meals increases. So the QSR industry in particular has become 10x between 2010 to 2019. And even after such a massive growth, the industry still represents just 4.5% of the total food services market in India. This suggests that it has a long runway for growth ahead of it. And it's not just a trend, it's a mega trend. During the last 6 to 8 quarters, the industry is going through a slowdown. This is because of three key reasons. First, increased inflation led to an increase in the prices of the offerings. Second, because of a slowdown in the economy, there were multiple job losses. And lastly, increased competition within the QSR industry. The last time when there was a slowdown, the bounce back was very sharp, and we can already see multiple indicators suggesting that the middle income expenditure is now coming back, and also the inflation has softened. Domino's same-store sales growth has also now stabilized, and I believe first half of next year is when the industry also starts coming back. But if we wait for the confirmation, the stock prices won't be the same. Within the QSR ecosystem, my favorite format is KFC. And this is not just my love for fried chicken. KFC is the fastest growing format over the last few years. And this is because of the company getting a lot of things right with its format and unit economics, details of which we'll discuss later. But the key thing to notice here is that the store level EBITDA margin for KFC is now at par with the bestest of the best. Also, chicken as a category is not very easy to get into because maintaining its consistency and supply chain at scale is not very easy compared to pizza, where processes are set and very easy to replicate at scale. The reason why we're not discussing a lot about Pizza Hut is that the company is yet to get a lot of things right, and KFC is almost 80% to Sapphire's EBITDA. So now in Sapphire Foods, Sapphire currently operates about 880 stores across India and Sri Lanka, and they'll continue to add about 80 to 100 stores every year, majority of which will be KFC. So the key thing to notice here is that they significantly stepped up their store addition post 2019 because they significantly reimagined their store format both for KFC and for Pizza Hut. So let me spend a minute here. Store size for KFC was about 2800 square feet, and for Pizza Hut, it was about 2500 square feet. They reduced it by 45%. And because now delivery is a very big thing, their average daily sales did not reduce. So now they were enjoying the same amount of sales at a significantly reduced operational cost, which significantly improved the unit economics. We have spent enough time on KFC, now on Pizza Hut. So Pizza Hut as a format has been struggling since a very long time now. Their same-store sales growth was degrowing in double digits since the last few quarters and has now finally started to rebound. So any sharp recovery here or any intervention turning this around can be a wildcard for the company. On Sri Lanka, where Sapphire is the largest QSR chain, it used to contribute about 20% to Sapphire's total EBITDA. But because of the huge downturn in the economy, the profitability took a huge dive. Not much to comment here, but going forward, the margins for the Sri Lanka business should normalize. Now on the financials and the valuations of the company, given the slowdown in the industry, the revenue and EBITDA expectations from the company has significantly come down. I believe when the industry starts to come back and it shows a couple of good quarters, the earnings revisions can be very sharp. Even after being one of the strongest consumer discretionary companies, Sapphire trades at a very reasonable valuation. I believe the major reason behind this is the shareholding pattern of the company. The company is majorly held by a private equity firm which is continuously selling. Because of that, there's excess liquidity to the stock. Given the consumption sector is very hot and the company has a very solid foundation, I believe it becomes a very good acquisition target for someone like a Devyani who want to make their footprint even stronger, or someone like a Berman Group who wants to enter the industry. So that's it for today. Happy to answer any queries and would love to meet more of you offline. Thank you so much. Bye.